Hello and welcome into the KE Report. Shad and Corey here as your host, and we're talking with our friend and colleague John Rubino. You can follow John over at Substack. And John was debating changing the name of his Substack. He had a couple other ideas. He even put out a poll to his readers, but I think he's just sticking with John Rubino on Substack because that came back as the most popular answer. So always appreciate having you on the show, John, to dive into the macroeconomic picture and then also our world of the resource stock investing and some of the things on the radar. And one thing we've been talking about in our last few discussions was our expectations were Q2 earnings were going to be blowout quarter because of the record high gold and silver prices. And we kept asking other people, are these factored in? Have people properly valued these? And a lot of the people we asked that question just said, oh, yeah, the markets are forward looking, guys. This is all, everybody knows the gold and silver price is higher. It's all factored in, it's all priced in. But as we have seen, starting with Newmont, where it popped 7%, granted it gave a little bit back, but then it's back up again. And then ever since the earnings seasons have continued forward, we've seen stocks like Core Mining jump up 14% the day the earnings were released. Hecla Mining jump up 18% the earnings were released. As we record this today, Equinox reported it jumped up 14%. Those are double-digit moves in big, large producers. And if they were properly factored in and if the forward-looking market was efficient like people say it is, that wouldn't have happened. We are seeing a big jump because people are being surprised by how well these earnings are coming in. It's not a surprise to us, though. So, John, just what is your initial feedback after watching a lot of these producers put out their numbers and seeing the reaction in a positive way, a spring forward in a lot of these mining stocks?
Okay, two things are happening right now. One is that you got some bubbles going on out there. Nvidia is $3 trillion market cap, and Bitcoin is what, 121,000 right now, some crazy number like that. So people who are watching the markets, but without any real, dog in the fight, any real asset that they pay most attention to. They're seeing stuff out there that attracts their attention, and it's not gold and silver, even though gold is doing great. I mean, if you tell the average investor that gold is the best performing asset other than Bitcoin in this century, most of them will be pretty surprised to hear that. But gold has outperformed the S&P 500 in the last 25 years, but people don't see it yet. And part of that is because the last 10 years or so for gold were pretty boring prior to the couple where it embarked on the new bull market. And it takes a long time for people to change their minds. So to the extent that anybody was paying attention to mining stocks, say, starting in 2012, 2013 or whatever, they lost interest somewhere along the way. And it's going to take a series of good numbers. In other words, a lot of information contradicting their preconception to bring them back into any kind of enthusiastic position about precious metals. But we've had 3 good quarters so far. So the question is, how many quarters of blowout earnings do you need before all of a sudden these guys start showing up on generalist investors' stock screens and momentum? And, there are a lot of people out there who don't care about mining, but care about things that are moving in the right direction. And you would think that the mining stocks would be showing up on those screens pretty soon. So that's part of what's happening right now. The people you talk to who said, oh, the good quarter is priced into the stock price. See, they're assuming that without really paying any attention. And the fact is, those good numbers were not priced into the stock because nobody's paying attention. A handful of people are, you and I are, but most people really aren't. And so great numbers come as a surprise. But if you're surprised a couple of times, the human mind tends to turn that into the reality for the foreseeable future. So I think we're getting there pretty soon, where the numbers will be priced in and the price will be a lot higher to take that into account. So here we go, because next quarter is going to be very good. Also, we're halfway through the third quarter now with gold and silver prices higher than they were previously. And that means a lot of good earnings, other things being equal, for the miners. And also, the miners have been generating free cash flow as a group now, or at least the well-run miners have, for a year. And they're putting that cash to work one way or another. They're paying off debt, they're raising dividends, they're buying back stock, they're making strategic acquisitions. So they're becoming better companies at the same time that all this stuff is going on. So not only are they more profitable in the moment, but their profile is improving. Whatever rough edge they had, $1 billion of free cash flow helps them sand that rough edge off. So all of a sudden they get a lot shinier and better looking from any perspective. So this is just a great time for the miners. And if we assume that gold and silver are in a bull market that's continuing, that this isn't the peak, which it definitely isn't. I mean, we got to talk about government debt, et cetera, as a way of determining when inflation hedges peak. We're nowhere near there yet because the underlying fundamentals haven't even begun to change. So that means gold and silver will be at this level or higher on average, probably for a long time to come. And that means the miners get to generate more free cash flow. They get to improve themselves. They get to do all kinds of wild stuff like just start buying the explorers at crazy premiums. That's still out there waiting to happen, and it will pretty soon.
Yeah, we'll need to see when that money does filter down truly to the explorers, but it does seem like these majors still very much focused on larger projects and more developed projects. But across the board, it was really record free cash flow, driven by higher gold and silver prices for all the majors and even all or a lot of the mid tiers as well. But John, that whole concept of people not paying attention to the stocks, they are paying attention to the metals. We are seeing close to record inflows into the gold ETFs. We haven't seen these inflows since 2020, and then even before then, decades ago. But the question is why investors aren't looking to the underlying equities. Is it marketing problems? Is it the fact that the metal is providing them with the leverage that they want? Is it the fact that some of these big institutions maybe aren't predicting much, much higher prices in the future? Why do we see that discrepancy between money going into the gold-backed ETFs, but not so much or not to the same extent into the stocks?
Well, because the human mind works very slowly when it comes to forming new opinions. And people are coming around to gold and to an extent silver as good things to own physically. And central banks have always been buying, and they're still buying, though not as much as in the past few years, but they've been kind of a steady wind at the back of gold and silver. And at the same time, a lot of the people who are buying, physical ETFs and stuff like that, formed an opinion that the gold miners suck. It's a terrible business. Their costs are too high for them to make money, even with higher gold and silver prices. And they haven't been disabused of that yet because it takes a long time. You need lots of new information coming on before you change your mind about most things. And, the mining sector is part of that process. But we're seeing a lot of action. I mean, most of the stocks that I'm watching closely or that I have in my Substack portfolio have had phenomenal year-to-date runs. That's the chart that I'm using now is just year-to-date. I'm not paying attention to what came before. And most of them are, 50, 60, 70%. And some of them are triple-digit percentage gains and everything. So somebody's paying attention now. Somebody's starting to buy these stocks. And I guess my point is that for everybody who's buying the stocks now, there are 100 people who are momentum investors or who are traders or whatever who haven't tuned in yet because there's other stuff attracting their attention. And they represent immense amounts of money compared to how much is going into the junior mining space right now. I bet if we added it all up, it would be less than the weekly trading volume of Nvidia or something like that. So there's just so much more money out there waiting to come in. And the numbers that miners are putting up right now are the kind of thing that eventually gets people excited when they start paying attention. But what would really help would be Bitcoin and Nvidia to top out here and start just churning for a while, or maybe have corrections or something like that. Because if something happens to scare people out of things like that, that money has to go somewhere. And there's a ton of it, So even if a little bit of it flows into mining stocks, which are still putting up good numbers, then you'll see these things just take off. I did a Substack post the other day about how in the royalty space, the really big players and the really small players are kind of putting up similar numbers. Just the magnitude is different. But Franco-Nevada and Gold Royalty reported in the same week. And they both had, more or less unchanged GEOs, gold equivalent ounces, but a big jump in revenue because the ounces they did sell went up. And then free cash flow, really nice cash flow numbers that work their way down from revenue to earnings to EBITDA to free cash flow. So they look pretty similar, except you need to add a zero or two to get up to FMV side. And, so Gold Royalty, $500 million of market cap, that is nothing compared to the amount of investable capital that's out there sloshing around. And if so, some tiny fraction of what's in Bitcoin right now sees the numbers that something like Gold Royalty is putting up, they could quadruple it in a week just by throwing 2 or 3% of their investable capital into something like that. So I think that's what we're going to see going forward, just because, first of all, that's how the human mind works. Second of all, the miners have a good long time of nice numbers coming out. Even if gold and silver just sit where they are right now, the current free cash flow allows these guys to do a lot of interesting stuff and to improve themselves. So they get better, even if gold and silver just not necessarily correct, but if they just churn from here for a while, which gold has been doing since what, like March or something like that. It's been a long consolidation already. So you don't need a dramatic increase in gold prices going forward for the miners to put up better and better numbers for at least another year. So I think another year should do it. I mean, if we have 8 quarters of really good numbers for the miners, then that's the new reality. And anybody who's watching isn't going to think, oh, they're done now. They suck. It's a sucky business. They're thinking, wow, imagine if you extrapolate these numbers out for 10 more years, because obviously it's guaranteed that it's going to happen for 10 more years. And that price is cheap, in those terms. So that's just how people think when markets really get going. And we're at the very early stage of that with the miners.
Well, John, I'm glad you brought up the royalty companies there, just because, if you look back, this isn't just 1 or 2 quarters of success for them. This is 2.5 years, or sometimes 3 years in some cases. A lot of these things bottomed in 2022, like we were talking about off mic. And same thing with the quality gold producers. A lot of those bottomed back in 2022, and they've been running for all of 2023, big time running in 2024, and all of 2025. Now it's filtered out into more of the mid tiers and some of the lesser followed smaller juniors, and they're starting to get more traction down in the developers. But the royalty companies have been running for a long time. And you also, in your Substack channel, put out some article recently where you were just highlighting a lot of your portfolio positions. And, you were talking about Sandstorm and the record revenues, and Triple Flag record revenues, and Wheaton Precious Metals like all the way down the list. Even if their production was flat, what do you think happens when some of their assets, because a lot of these companies have assets in their portfolio that aren't even being given any value right now, but they're about to come into production? And like we've talked to a lot of these companies, a lot of them have assets that come on later this year, the beginning of next year, that then start boosting those gold equivalent ounces. What do you think happens to these companies when people realize not only are the revenues solid and continue to go up, but now they're growing again? Because we haven't seen that in the royalty space. When it starts to grow, plus the higher prices, do you think that attracts some capital that maybe shies away from mining stocks, but would be game to be in royalty companies?
Oh yeah. Well, first of all, the royalty companies are just this good business model. They aren't spectacular winners in a bull market, but they definitely win. When the price of what they're selling goes up, their margins just blow out and they make lots of money. And that's what's happening with them now. But one of the things that I've heard from you guys for a while is that the sweet spot in the mining space right now is growing producers, because you win twice. I mean, if you're producing something that is going up in price, that's great. But if you're producing more of it, then you have operating and financial leverage, and you can report absolute blowout numbers. And I think that's what's going to happen for some of these royalty companies, where people got used to a given level of gold equivalent ounces without really paying attention to this new mine that's coming online and what it's going to, I think Sandstorm was about 5 years too early with the big acquisition that they did, because a lot of the royalties that they picked up when they made the acquisition weren't producers yet, but they're becoming finally at long last. So it could be that Royal Gold timed that acquisition really well, because Sandstorm was getting ready to report some really surprisingly good results that people weren't ready for. And I think that's happening in various ways across that space because a lot of these royalty companies are pretty young too. So they've just made their acquisitions a few years ago, and they were probably buying into emerging mines that take a long time to get going. And when some of those things get going, some of them are big enough just alone to move the needle for some of these little companies. So yeah, I think in the royalty space, there's going to be an acquisition binge where the big guys snap up the little guys. And that's in some ways kind of unfortunate because some of these guys who are potential 10 baggers will get bought out at a double or something like that, which is, it's nice in the moment, but it lowers your long-term, oh my God, I'm going to be so rich kind of quotient with a portfolio like this.
Hey, we have seen that churn, and we have seen some of the smaller royalty companies get taken out. But John, if we play this scenario out here where the metals price has mostly gone sideways for this quarter, it was up from last quarter when you consider where it started Q2. But if the gold price doesn't keep moving higher, then these numbers are going to stay good, but they're not going to keep hitting record numbers in terms of free cash flow, in terms of revenue. And we do have to consider pretty much all the stocks in the precious metal space have revalued. If you look 6 months to 12 months ago, most of these stocks are up usually double, if not even more than that. So don't we continue to need a higher metals price to keep putting out record numbers? Because I don't know, it just seems like in my history, when we have seen a flat metals price, the stocks eventually start to fade because the metals price is that momentum that drives these better numbers.
Well, those previous flat metals prices were $1,800 an ounce or, less than $2,000 an ounce in most cases. So this is a completely different animal now because $3,300 an ounce generates a lot of cash flow for these guys. So let's say your cash flow doesn't grow sequentially quarter over quarter, but there's a lot of it. So you take some of that cash flow and you pay off the debts that you incurred while you were doing some big acquisitions. Well, all of a sudden you don't have to pay that interest expense anymore. So cash flow is increased by the interest expense which you've saved, or you increase your dividends, so you become interesting to a new group of investors. Or you make an accretive acquisition, which is that's kind of the risky thing because the definition of accretive changes with the excitement in the market. So as long as they're making smart acquisitions, cash flow goes up, or they buy back stock and per share earnings and cash flow go up when they do that. So the numbers can stay good and they can trend upward for quite a while, even if the price of gold and silver don't go up much from here because it's high enough as it is to generate enough cash flow to make a lot of good things happen. Now, if there's a big correction, if gold goes back down to $2,500 an ounce, then yeah, you'll see lower cash flow in a lot of cases, and that would hurt the stocks. But assuming, we should probably tag a little discussion of why gold and silver are likely to go up instead of down going forward, because that's a big part of the story. But you look at the U.S. government's debt; it's astronomical, and it's only rising. And you look at what's happening right now with the Fed, and we just had a consumer price index number of like 2.7% annual rate, and then the producer price index just came in at 0.9%, which is a massive increase for 1 month in producer prices. Now, some of that is tariffs and stuff, but it's still inflation that's above the Fed target rate. And the Fed is getting ready, everybody thinks, to cut rates in September, while Trump is getting ready to name new Fed board governors who are on his side about lower interest rates. The US government wants much lower interest rates from here, even though inflation is above the target range that would normally lead the Fed to raise interest rates. So basically, we've basically just given up, which is one of the things that happens in theory in a crack-up boom, where governments just say, screw it. We just got to keep financing this debt. We just got to get out from under it by devaluing the currency so we can pay it all back. And that's when the system basically blows up. And so we're creating the conditions. Or actually, I would say we've gone beyond creating the conditions. The conditions were here, and we're actually implementing a crack-up boom right now. And that's just the US. You look over at Europe, I mean, they're already committing cultural suicide in a lot of ways, but they also decided to embark on a massive military upgrade where they're going to apparently increase their military spending from 2% of GDP to 5%. And since they're already running massive deficits, that's all borrowed money, that new military spending. So they basically have given up on trying to stabilize the value of their currency. They just said, screw it. We're going to become the world's new military power. And whatever we have to spend to make that happen, so be it, And those are the kind of things that blow up currencies. So gold and silver as safe havens in that kind of an environment, there's no reason to look at $3,300 gold and say, well, this is the peak. Gold is overvalued now, because gold only exists in terms of value relative to the currencies in the countries where it trades. And if we're blowing up all the big currencies, then there isn't an upper limit for gold, and to the extent that silver is attached to gold for silver, because, if the thing you're valuing gold in goes to zero, that means gold goes to infinity mathematically. Not that we'll get to that place, but that's kind of the upside there when you think about it. I mean, if we're just going to inflate away the dollar, then that's the same thing as saying we're going to make gold go to infinity. So I think there's a very good chance that the price of precious metals and farmland and oil wells and lots of other real assets are going to go up when we measure them in these crappy, dying fiat currencies. And to the extent that gold and silver just keep up with the devaluation of the dollar, that's phenomenal for the miners. That means that their revenue goes up faster than their costs in most cases, and their margins just widen out, and the cash flow that they generate just goes up and up. And once this thesis starts to become a commonplace, then you're in a world with almost unlimited investable capital sloshing around out there. And where's it going to go? Some of it will go into gold and silver. If people start talking like this in the mainstream press, and I'll do my best, I promise, to get that idea out there.
Well, appreciate that, John. But yeah, I mean, the point you're making, I was just having a discussion with somebody anecdotally yesterday, and they don't invest in precious metals, but they were just like, why is gold so much? I said, well, gold hasn't changed, just on the elemental table. What's changed is your loss of purchasing power in the dollar. And they were looking at everything based on the dollar index. I was like, well, that's not doing so hot either, but that's a mistake, because what really is like, what does your dollar buy? The dollar index is measuring the dollar against other fiat currencies that are racing to the bottom. So it's not necessarily how your purchasing power looks. And the reason that gold is $3,300 an ounce right now versus $35 an ounce back in 1971 is because your dollar has fallen that much. And it just was like a news flash. They had never thought about it that way. That's not being taught in school, and that's not being covered in finances, and that's not being covered on mainstream financial media when they discuss gold. But just one last question for you on silver. You said it would go along with gold. Silver's kind of been marching to the beat of its own drum. It's actually been more interesting than gold in the second quarter, moving into the third quarter, because it actually is at a higher place here in Q3 than it was in Q2. And Q2, it was definitely a lot higher than it was in Q1. Gold kind of peaked out in April and has been trending sideways. So with silver moving on its own accord, it doesn't get bought by central banks. It's considered poor man's gold, but do you expect it to finally have that big move up to test the all-time high and to really get some momentum going in the pricing? And if so, how would that differ than the motivations and the macro factors behind gold?
Well, silver as a monetary metal usually takes off right about now in precious metals bull markets, and then it outperforms for a couple of years and ends with a parabolic spike straight up. So that would be okay right there if that was all there was to the silver story. But it is an industrial metal now on a scale that it's never been before, because the new generation of solar panels use more silver than the old generation of solar panels. And there are these new car batteries coming out. Have you seen these things? The claim is that the next generation of car batteries with a 9-minute charge will get 600 miles of range. So that sounds crazy, but major companies are bringing these things out and talking about it like that's a real thing. And they use a lot of silver. And then, missiles and things, they don't tell us how much silver is in missiles, but it looks like everybody's out there buying missiles and there is silver in them. So industrial demand is looking like 80 to 85% of silver mine output in another couple of years. And if that's the case, then there's very little left for monetary metal buying. And that kind of a shortage sometimes leads to panic buying. And it seems like in this case, it could easily, because, if we're talking about gold as a small market compared to Nvidia and Bitcoin, silver doesn't even show up on the charts where you put Bitcoin and Nvidia. It's down there with a little arrow that says zero, pointing where silver would be if it was any higher than 0%. And so it's so small that even a tiny bit of money in the generalist economy flowing into silver would it would turn it into unobtainium. You wouldn't even be able to get physical silver at that point. So, and that's a very real possibility out there too. So if that happens, then mining stocks become a way to buy silver, because that silver exists in the ground and you can buy it if you just buy the stock. And if that's the only way to buy it, then any price is acceptable. No price is too high, because that's the way bubbles work. So that's a possibility with silver. And even if the really crazy part of what I said doesn't come true, it's still pretty cheap relative to gold. And it's an industrial metal that has a lot of uses. So it's still a good story. It's still a thing to own, even if the really extreme scenarios don't actually happen.
Well, we'll definitely keep following along with silver, gold's scrappy little brother, and we'll follow along with gold, and we'll follow along with the moves in these mining stocks. But yeah, the earnings in Q2 here for the producers and for the royalty companies were blowout numbers, and there's no indication that Q3 is going to be any less. It looks like it's going in an upward trajectory. Hopefully that gets on more generalist investors' radar screens. And I appreciate you coming on and sharing your thoughts and kind of unpacking some of your recent Substack articles. And to that point, if those listening in want to follow along with John, definitely check him out over at Substack. We'll put the link down below. He always writes about interesting things, whether it's the resource stocks, geopolitics, economics, the macro, the micro. So appreciate you coming on the KE Report as always, John, and looking forward to our next conversation.
Thanks, guys. Talk soon.